you need to be very thoughtful about when do you change your price and when do you notify your clients. If you're an online retailer, your price is your price. You can change it one day and people will buy it or they won't. But if you're in a B2B business and it's about long-term relationships with long-term clients, you don't want to spring a price increase on them. Hi, I'm Josh Bartel, CEO of Hydrian. Today, I'm going to talk about price changes, which, if you're anything like our clients, you've probably seen a lot of lately. Most of them are directly or indirectly related to tariffs, but not all. Today, I'm going to go through some of the observations about what we're seeing, how our clients are responding, and some of the strategies that we're helping them work through to mitigate the impact of price changes and maximize their profits. So one observation that's a pleasant surprise is that importers who are directly exposed to tariffs have shown a surprising amount of flexibility in working with our clients. Example might be they have a 25% tariff that applies to all the goods they sell, and they're willing to give you a 10% discount, at least in the short term. I don't know how long these sort of sharing the burden type deals are going to last, but ask for them if you're not getting them, because suppliers overseas have been remarkably open to this kind of idea. The second thing I want to talk about is an observation that's less pleasant, which is that suppliers that don't have tariff exposure are still using tariffs as an excuse to raise prices. I would imagine most of you suspect that this has been happening at least somewhat, and we have pretty strong evidence that it is. Recently, there was an example where a major supplier for one of our clients had a 7% price increase, citing tariffs as the main reason. They'd made many public statements. They're a public company, and we knew that their tariff exposure was actually minimal. We sort of armed our client with that information. They ended up having a conversation. And then the conversation became much more like a normal price increase conversation. Oh, well, we've held price for a long time. The tariffs are really the straw that broke the camel's back. We've been meaning to do this. Ultimately, they ended up turning that 7% price increase into a 3% price increase. So arm yourself with information. There's usually more out there that's available than you know. And don't be afraid to push back if you think you're getting pushed around. The last observation that I wanted to share with you is really around inflation. How does inflation play into all these price changes? So what I want to point out about inflation at the time of this shooting in June of 2025, where inflation remains surprisingly low, at least it's been surprising to me. But the consensus estimate among our clients in surveys we've done over the last few weeks is that inflation by the end of the second quarter this year is going to be at 5%. So about double what it is right now. Whether our clients are right or wrong doesn't really matter. What's important about that fact is that if they believe that's the case, and they do, they're going to respond by doing a few things. One is taking more aggressive inventory positions, buying more stock now before inflation happens. The second is that they're generally bracing themselves and their businesses for a stormy next few months. In addition to that belief about higher inflation, most of our clients also believe there's going to be slower than normal economic growth or a recession. So we're talking about a stagflation situation, and that's going to mean trouble for their business. So we're seeing people accumulating cash and other short-term liquid assets. And it's kind of a balancing act between, do I want to take on more inventory now before I believe prices will get higher? Or do I want to be really conservative because I'm worried about future demand and I want to hold less inventory? Right now, the bias has definitely been towards hold more inventory when they can, but people are definitely have expectations about prices. And sometimes those expectations are just as important, if not more so, than what actually ends up happening. One more thing I want to mention too is supply chain disruptions. We are starting to see in June 2025, as we predicted a couple of months ago, some supply constraint. In other words, we're seeing empty shelves among certain retailers, certain products. I sort of liken it to the COVID shortages, where nobody could buy appliances and several other items for a long period. I think it's going to be much more mild than that, but it is going to be very real. So there's going to be scarcity. This relates to prices because obviously scarce things cost more to acquire, and you can also sell them for a higher price. So just something to keep in mind. We do believe that the impact of the sort of moratorium on buying from China, for example, that's happened over the last couple of months, it's now beginning to impact retailers' inventory. That's going to impact the customer experience pretty significantly. So anyway, the world's changing. All this stuff is happening. What can you do about it? Well, I've mentioned working with suppliers and pushing back on price increases, those sort of strategic type decisions. But what systematically or process-wise can you do? Well, one thing is you generally want to, at all times, have a somewhat more responsive forecast than most companies have. The really egregious example that's really common is that when companies talk about what they're going to sell or their purchasing planning, it's based off of a simple average of the last 12 months of sales. And that's really never a good forecast, but it's particularly dangerous right now because with these price changes and your sell price changes, your position in the market can change really fast. And you might see sales go up or down, depending on if your price is relatively lower or higher than the rest of the market. If you have a long-term view in your forecast, it's going to be really inaccurate in predicting what future demand is going to be if there's been kind of that step change up or down. So make sure that you have a system that supports a really responsive, more sort of recency biased forecasting approach. And then one way to get around this, even if you can't update the way your system works, is just to run your forecast and demand planning process more often. We see people running that process, monthly, quarterly. If you're in a position where your industry is changing rapidly, maybe you should do it weekly or every couple of weeks, at least in the short term until things settle down. The next thing I'll talk about is flexible sourcing. It's always been a good idea to have secondary and tertiary backup sources for the products that you sell. We recommend not only knowing who those companies are, but starting to have some level of buying with them. So let's say you import your product from overseas, you get really great pricing. Maybe reserve 10% of your purchasing for a domestic source that's not nearly as price competitive, but you maintain that relationship. You know who to call at that business when you're trying to get to the front of the line for an order. And if you do need to sort of drop your import supplier suddenly, you can shift your demand. You already have that relationship open. It's not just, it's not just an option in your system. It's actually a company you work with on a regular basis. So really have those secondary supplier relationships and nurture them even when you don't need to. And then of course, just continuous monitoring. So if you change price, how do customers respond? Make sure that you're really watching how sales evolve, keeping a close eye on item profitability. If you're selling something for $10 and you buy it at $5, you feel pretty good about yourself. If your price goes up to $9, well, your current inventory, which is usually how most pricing systems are based, still has that very low cost, but you have this big expensive batch of product coming in at a much higher cost. You need to be very thoughtful about when do you change your price and when do you notify your clients. If you're an online retailer, your price is your price. You can change it one day and people will buy it or they won't. But if you're in a B2B business and it's about long-term relationships with long-term clients, you don't want to spring a price increase on them. So when you have some visibility and you've come up with your plan, sharing it as early as possible with your clients is always a good idea. Finally, I want to talk about a couple of misconceptions or errors that we feel clients are making. The first is that we're seeing people making the assumption that this is not going to last. The current kind of instability and volatility, the tariffs, whatever we're talking about, this is a short-term thing that's going to go away. Even if that's right, I think it's imprudent to run your business that way. I think you need to be taking news as it comes in, and whether it's tariffs or supply constraints or lead times increasing or whatever's happening in the world, you need to start organizing your business around that new normal and not just hold your breath and hope that it all goes away, because the odds are it's not. And again, even if you're right, you don't want to take that risk. And the second major error we see people making is this idea of I'm going to buy when prices are low. This is most common among our clients that are highly exposed to commodities. Think like our clients that sell fasteners, which are highly correlated to the cost of raw inputs like steel. The price of steel is updated every day. The market price changes and it's quite volatile. So you might say, wow, price of steel looks really low today. I'm going to go buy a bunch of inventory with these lower costs and save myself some money. I think that if you knew what the price of steel was going to be 3 or 6 months from now, you should quit your job as a buyer for the distributor you work for and go play the financial markets, because you can make a lot more money. Truth is, nobody knows what's going to happen with commodity prices or any prices. That dip that you see could be the start of a tumble down to another 20% lower. Now you're going to look really silly for having stocked up on inventory. So generally speaking, I would say don't be the day trader, commodities day trader, and try and time your purchases in any way. I just don't think it makes sense. The one exception might be if your sell price is very stable. So for example, you buy raw input materials and the price is really volatile, it changes daily, but your sell prices you can hold for 6 months, no problem. If the price is low enough where you can make money and you're worried about future price increases, maybe you do take on a bunch of extra inventory because there's really no risk. But generally speaking, I'd say buy the amount of inventory you need to serve your customers well. And if prices go up, then you can increase your sell prices if and when you need to. But I think trying to make money by effectively playing like an arbitrage or a hedging game is not how you make your money. You're a successful distributor or online retailer. You are not a commodities trader, so don't try to be one. All right, that's all the advice we have for this session. We do these videos every week or two, and they get posted in various ways. So we'll keep this content coming. You can always reach out to us and request topics for us to cover. In the meantime, have a great rest of the month.